So hello everybody, I'm back to continue with the slides here from chapter 15. I'm on chapter slide 25. There is a discussion here about what happens if you have debt and you keep the debt permanently, and you can see that it's treated as a perpetuity, right? Something that goes on forever is considered a perpetuity. So if you look right here, you'll notice they say a perpetuity and the debt is permanent. Well, the way to handle that is here's the equation for the interest tax shield at the risk-free rate. And you'll notice that the debt, the amount of debt times the risk-free rate and gives you the interest. And the risk-free rate's going to cancel out. And you're going to end up simply with this equation here, which is your marginal tax rate that you're in times the debt. This is assuming, of course, that the debt is riskless, as stated. But again, it's like it's treated as a perpetuity. So basically, one can look at the debt, and obviously one can obtain a market value of anything. And if you look at the market value of the debt, and all it's going to be is the present value of the future interest payments, which of course is very similar to a bond, right? So a bond, how do we get the price of a bond? We take the present value of the coupon payments. So this is a very similar idea. So basically what we have here is with a constant tax rate, we take the present value of the corporate tax rate times the future interest payments, and basically we could get the present value of the future interest payments and pull out the TC from the equation because that's constant. And the present value of the interest tax yield is just the present value of the marginal tax rate times the amount of the debt. So basically that's basically what you get with this equation here. Okay, so if I've got tax deductible interest, as I normally do if a company issues debt, the effective after-tax borrowing rate, right, and similar to your mortgage, right, is as shown here. And you can get your weighted average cost of capital depending on your mix of equity and debt. So here is your, basically if you look here, here's your pre-tax weighted average cost of capital. This, of course, is the equity component, and this is basically the ratio of how much equity you have to your total valuation. And here is your debt ratio, right? And here's your basically your cost of capital on the debt. Here it is on the equity, and this is the pre-tax portion, and here's the reduction with your interest tax shield. So again, here's the debt ratio, and basically here's your the coupon, the required return on the debt, and here's your corporate tax rate. So basically, this equation gives you the weighted average cost of capital with the tax shield involved. And it's a pretty simple equation. Basically, you just plug in. And again, there's two components, the pre-tax and the reduction due to the tax shield. And basically, notice that'll lower your weighted average cost of capital. So if you look at this graph, this is a pretty busy graph. Something that you should notice is that as I take on more debt, right here, you notice the debt to value ratio. As I take on more debt, my basically I'm taking on more risk, and it's going to be reflected in my equity cost of capital. So it kind of makes sense that you're going to have to pay the common stockholders more return. So you'll notice here the debt to value ratio increasing, and it's going to cause the equity cost of capital to go up accordingly because of the increased debt. Here you have the basically after-tax debt cost of capital, and this is you're basically debt cost of capital pre-tax, and basically here's the two curves that show your unlevered pre-tax weighted average cost of capital and your weighted average cost of capital with taxes, which includes the equity and the debt component. So there's a lot of stuff going on here, but the important item is really notice how your equity cost of capital goes up because of the increased amount of debt you're taking on. All right, so I'll kind of jump ahead a little bit. All right, so there's an example here which is in your book on page 15.3. And basically, Western Lumber Company expects to have a free cash flow of 4.25 million, and it's going to grow at a rate of 4% a year thereafter. Western Lumber, their equity cost of capital is 10%, and their debt cost of capital is 6%, and their corporate tax rate is 35%. So if Western Lumber maintains a debt to equity ratio which is 50-50, right? What is the value of its interest tax shield here? And here's the equation we saw before. This is the pre-tax weighted average cost of capital. So we can solve that if I can get over here. And basically, once we get that at 8.67, we'll take that weighted average cost of capital, and we'll put that in our unlevered valuation equation here. Then we could basically get the weighted average cost of capital with the tax shield, and here's the equation for that. So we've seen these equations before, and you'll notice that the interest is before taxes was 8.67, and here it is at 7.97. Very similar, I assume, to your mortgage, which you probably all know about already. And here's the value, or here's the unlevered value without the tax shield, and here's the levered value, as you see, VL, with the tax shield. So if I get that tax shield, and I get the basically the present value of my interest tax shield is basically the levered minus the unlevered, and I just simply subtract the two. Here's the 91, and here's the 107. And it comes out to $16 million. And here's an alternative example, similar to what we just did. And again, you can see them going through this whole thing again with the unlevered, the pre-tax with no tax shield. And here's the unlevered. Here's now with the tax shield included. So it's a similar example to what we just did. Okay, so basically now we get into recapitalizing to capture the tax shield. Sometimes a company doesn't have it and they want to recapture, they want to recapitalize to get a tax shield. So they want to boost its stock price, and the company has 20 million shares outstanding. Right, the market, it's $15 a share, and they have no debt. They've had consistently stable earnings, and they have a 35% tax bracket. They want to borrow 100 million on a permanent basis, and they're going to repurchase outstanding shares with the money that they borrow. So without leverage, basically the unlevered valuation of the company is at 300 million. If you simply multiply 20 million shares times $15 a share, if they borrow 100 million using permanent debt, the present value of the future tax savings is going to basically be $100 million times their tax bracket of 35%. So the total value of the levered firm is now going to be $335 million if I simply add up the 300 plus the 35 over there, right? And All right, so because the value of this debt is 100 million, the value of the equity, I simply subtract off the debt, and my equity value is $235 million. So the value of the shares drops to 235 million, and shareholders also received 100 million that basically was going to be paid out through the share repurchase. So the shareholders, they'll get the full $335 million gain, which is a gain of 35 million over, if we go back a minute, without leverage. And you can see here was the value without leverage. And you can see the leverage brought up the shares by $35 million by taking on debt and having a tax shield. All right, so what happens if they purchase the shares at $15 at the current price of $15 a share? They're going to end up repurchasing 6.7 million shares. And how do I get that? Basically, it's 100 million divided by $15 a share. So it then has, instead of having 20 million, it'll have 13.3 million shares outstanding. If I subtract these off, if I repurchase this amount, so I'm left with 13.33 million shares. And then the total value of equity is going to be 235 million. So the new share price will be, if I divide 235 million by 13.33 million, it'll come out to $17.625 dollars a share. So you'll notice if you keep your share, there's going to be a capital gain of $2.62 per share there. So here's the total gain to shareholders. It's 35 million, which is 2.625 times 13.3 million shares. So if the shares are worth basically a little over $17 a share after the repurchase, so your question is, why would the shareholders tender their shares to Midco at $15 a share? So basically this has got to be priced correctly to present arbitrage. So if they could simply buy the shares for $15 immediately before the repurchase and then sell them, there's an arbitrage opportunity. So that becomes a problem. So basically, realistically, so the value of the Midco's equity is going to rise immediately from 300 million to 335 after the repurchase. So basically, with the shares are going to go up to 1675 a share. Okay, as shown here, if I have 335 and I divide that by 20 million shares, that's what the shares will go up to. So we've got to price this really to prevent arbitrage. And you'll notice that the gain is actually, to prevent arbitrage, it's going to be $1.75 a share. So this is for the people who tendered the new shares, and basically and the people who hold the shares will equally get distributed $1.75. So you'll notice, to prevent arbitrage, the benefit of the interest tax shield goes to all 20 million shareholders, the ones who sold and the ones who did not. So basically, with so if a security is fairly priced, which means to prevent any arbitrage opportunity, the original shareholders capture the full benefit of the shield from an increase in leverage. All right, so I'll stop here. I got a 14-minute video, and I'll pick up here again at slide 50. All right, so I'll finish up the slides in the next day or two. So we have a video of this.